It was big news this month when the Federal Reserve decided to raise the short-term interest rate for the first time since June of 2006.
The 0.25% rise is a small one, but it's possible we could see a few more gradual rate hikes in the new year. So what does it all mean for the average consumer? And are there things to consider right now if you're thinking of making a big purchase or depositing money in the bank? They're all good questions addressed in this week's Business Matters. Whether there's a big purchase on the horizon, for example, a house or a car, or you're saving for something big with money in the bank, the small interest rate hike put into effect this month by the Federal Reserve affects millions of Americans. For consumers, the question is, what do you need to know right now to take advantage of the current interest rate and the possibility of rising rates in the new year? We put those questions to certified financial planner Bill Wixon of Wixon Advisors in Maple Grove.
There's some good news that investors or savers at the bank are going to get higher interest rates on CDs and on their savings deposits. It won't happen right away, but it should be easing up. Second, I would say if you're paying interest on your home or a car now, find out what's going to happen to those interest rates. See where they're going so you can prepare and plan for it.
Given the fact that we could see continuing interest rates rise, what should people know right now? Perhaps if they're thinking about a big purchase, a home, a car, is now the time to do it?
I would say, once we get that first raise in interest rates, they usually continue. Unless there's some economic event to really spiral our economy downwards, they'll continue to go up. So I would say yes, if you're contemplating a purchase of a home or a car and you're going to borrow money to do that, I would say a little sooner than later, actually, to take advantage of the low interest rates on the permanent plans that are still in effect.
And finally, credit card debt. Should people be thinking about paying that off? That's always good advice, but is it more applicable now?
Getting rid of credit card debt is great, but I would say you want to watch where interest rates are going and try to keep those interest costs to a minimum. Look at your statement and identify what you're paying in interest, and don't necessarily ever just pay what the minimum is. That's a formula to get a lot of interest in the bank's hands. You don't want that.
One other thing to consider, if you have an adjustable rate mortgage, check the terms, and you may want to consider locking it in now for 15 to 30 years to have a better idea of your overall budget going forward.